Namaste to all. I, along with my Vice Chair Abhay Chhajerji, welcome you all to this another webinar, a very important webinar on a subject which is actually very close to the heart of any accountant, I would say. And to discuss on this subject, we have got none other than our own past president and also the past chair of the ASB, CA Manoj Fadnis ji, who is an authority on accounting standard, Ind AS, anything on accounting. He is there to always help us. He is always helping the institute on any matters of the accounting or IFRS or Ind AS. Thank you, past President Manoj Fadnis, for joining this session today and to enrich the knowledge of members and students. Along with him, we have got another stalwart, CA Mohan R. Laviji, who is again having a huge experience and also a regular contributor to the ASB, also a faculty of the our certification course on Ind AS. Thank you, Lavi sir, for always helping us, and welcome to this panel. And to moderate these two stalwarts, we have got another young and energetic stalwart. I would just say Nitika Khewani Suji from Delhi, who is a good, I would say, a thorough student of not only accounting but of course the taxation. And these both panelists are of course past president and Lavi sir. They are a thorough knowledge into Ind AS accounting standards and accounting. But I would say Nitika is a keen learner on accounting aspects, and she would be asking the questions to moderating this. Friends, thanks for joining on this day. We were just discussing on another semi-final day, and we are having this discussion on the framework for preparation and presentation of financial statements. Friends, you may be understanding various accounting standards or Ind AS or IFRS, whatever it may be. But the basic thing for the preparation and presentation of financial statements, which is there through this framework for preparation and presentation of financial statement, which is, of course, a base document, a source document. Wherever you find any difficulty which is not given into the standards, where to go back to this framework. So having this discussion would be a great learning for everyone. And of course, this session today would be available on ICI TV as well as the YouTube. So if you find useful, of course, you will find that. I'll request you to please refer any accounting student or member to see this video later on also. I'll request my Vice Chair, C. Abhay Chhajerji, to give his initial views on the subject.
Thank you, Chairman Pramodji, and of course, truly it's an honor when you have the past president taking one of these sessions which we organize under the ASB, the Accounting Standard Board. And like you mentioned, that none other than our past president, CA Manoj Fadnis ji, who's been so much, I would say, the person behind. We talk about conceptual framework, we talk about AS, we talk about Ind AS. I think we've been hearing him for last so many years, and I think he's been contributing a lot. As a vice chairman last 2 years, I've been seeing Fadnis sir has been contributing so much in the accounting standards, not just on the meetings, but various groups which we have regular meetings on certain matters, decisions which we have to take it to the board or further to the council. I think it's always a big contributor, sir, and thank you so much for joining today. Truly an honor for all the participants also to listen to you again. And I'm sure with this session we'll have an excellent, more importantly, the panel discussion, because these questions which have been raised and then it's been answered, I think that's the key learning, and that is what we have initiated through the ASB to keep it in the form of panel discussion, because it really helps to have better clarity, understanding, and we get questions from the participants which are also further taken up, and really helps to understand the real conceptual framework for preparation and presentation of the financial statement. And again, Chairman sir, you mentioned about Mohan Laviji. Thank you so much, sir. it's just one call away. You are always available for any session on counting standards, Ind AS, or any topic of the ASB. You're always available. Thank you so much for joining. And Nitika, thank you again for moderating these two important stalwarts. I would say today it's very important for you to be up to date, of course, because those questions been asked and then been answered. Of course, you'd have to take a lead. You have to lead the show. So the more important. So thank you again for accepting as a moderator. And I'm sure the participants would really be benefited because, like Chairman Sir mentioned, that the conceptual framework, for preparation, financial statements, for preparation and presentation, we know about the companies, but there are a lot of doubts in terms of non-corporate entities which we have been facing, and more particularly, a lot of initiative which the ASB has taken in last couple of years. A lot of clarity was, of course, done, but still there could be some doubts, some issues which the participants may raise. Will have more clarity, more particularly, like I said, for proprietorship, partnership, or non-corporate entities, in preparation, presentation of financial statements, recognition, derecognition, the measurement, and how, important is the vertical format rather than, an horizontal format, and whether you should have a previous year figures to be mentioned, not to be mentioned. I think I'm sure the experts which we have today will really, would take us through all these panel discussion, would have complete clarity on whatever issues we have in terms of conceptual framework, and would really be, every participant, I must say, would really be benefited to get best out of learning for this webinar. So thank you once again, all of you, for joining, and thanks to Manoj Furnis sir and Mohan Laviji and Nitika for being here. And of course, we would have the concluding remarks at the end also. But I thought maybe it's always a privilege to mention this right at the beginning and of course at the end. So it's always a privilege for me to. Thank you. So over to you, Nitika.
Thank you so much, sir, for the introduction and a very warm welcome address. Good evening to the learned speakers, Chairman and Vice Chairman ASB, and our viewers from all over the country. The topic for today is of immense importance as it not only touches the lives of the businesses, but as well as us as professionals. And as the cricket fever is going on, so the opening batsman for today would be Manoj sir. To begin with, sir, if you could please enlighten us on what do we mean by the conceptual framework for financial reporting and why is it important?
Thank you so much, CA Nikita. And let me also thank the chairman and vice chairman for this excellent initiative to have the discussion on the conceptual framework. And I feel delighted, honored, and privileged to be part of this panel along with such an eminent person like Mr. Mohan Lavi. At the beginning, my greetings to all on the occasion of Diwali and the New Year, which is there. As you said, Nikita, there is a cricket fever going on. We have a second semi-finals happening today. And amidst that, we have this wonderful discussion going on a completely different subject of conceptual framework. I'm sure the way members are interested in this topic is evidenced by the fact that so many have joined this webinar, and good to have. I look forward to a very interesting discussion on this very important subject. So to begin with, as you mentioned, this conceptual framework. Friends, as all of you are well aware, we have two sets of accounting standards, and basis those accounting standards, we have conceptual framework and framework for the purpose of preparation and presentation of financial statements. I think both the chairman and vice chairman in their opening remarks have given a very good understanding to all of us as to what is the purpose of a framework. So when we have accounting standards, as they very clearly and very categorically mentioned, the accounting standards are based on certain framework, and that framework is the underlying, let's say, the premises on basis of which the standards are developed. So both for Ind AS, Indian accounting standards, as well as accounting standards, which today stand notified as part of Companies Accounting Standard Rules 2021, that is AS and Ind AS. they are based on the respective framework which we are discussing. And this framework gives the essential principles, the basis, as the chair and vice chair mentioned, about the recognition, measurement, the disclosure principles, or the overall broad groundwork on basis of which the pillars of accounting standards are built up by the Accounting Standards Board and the Institute. So when we look at any accounting standard, or be it a AS or Ind AS, we go by that particular accounting standard insofar as the matters which are stated in that accounting standard. In case we come across a situation where we do not find guidance in the accounting standard, or let us say on certain subjects the accounting standards are silent, in such cases we fall back on the framework to understand what is the meaning of the term assets, liabilities, income, expenses, equity, which are the well-recognized elements of financial statements, what is the purpose, what are the measurement bases, and so on and so forth. So the framework, the conceptual framework, is the underlying document on basis of which the accounting standards are developed by the Accounting Standards Board. And in case of issue, in case we come across an issue where we are required to design an accounting policy and we do not find sufficient guidance in the relevant accounting standard, in that case we fall back upon the conceptual framework. So to say that there is the conceptual framework gives the general principles and the accounting standards give the specific principles. So in that context, we need to understand the concept of framework.
Is it mandatory for us as auditors to ensure the compliance of this framework?
I would say that anything coming from the institute, we should take it as Gita, or we should take it as Bible and see that it is being followed. In the sense that whether it is legally mandatory or it is optional, certainly it is not optional. It is a duty of the preparers and presenters of the financial statements. It is the duty of the auditors to see that the relevant accounting standards are being followed. And in case there is no accounting standard, the basic principles contained in the framework are being followed. So in that context, while not getting into a legal debate about its mandatory nature, I would say the financial statements cannot give a true and fair view if the basic principles contained in the respective accounting standards, or in their absence in the framework, are not complied with. And therefore, I would say it is mandatory. One should ensure compliance with the relevant standards and also the basic conceptual framework.
So is this framework applicable to all the entities, that is partnership, proprietorships, LLP, company, or do we have any exceptions to it?
Yeah, that's an excellent question, Nikita. See, as I said, we have two sets of accounting standards. We call them as Ind AS. So companies' Indian accounting standards are based on this conceptual framework, which is on basis of which the Indian accounting standards are being prepared. And there is a Government of India Ministry of Corporate Notification of June 2021, which requires the preparers to ensure that the Ind AS are followed. The companies presenting accounts on the basis of Ind AS should ensure that they are in compliance with the notified conceptual framework. Insofar as the other entities which you mentioned, say individuals, partnership firms, or say LLPs, as you mentioned, for these entities, since the auditor is expressing a true and fair view. Now, what is true and fair is not defined in any law. So let's take the case of an entity like an individual. Now, if the financial statements of an individual, of a proprietor, or of a Hindu undivided family, or LLP, or a partnership firm is being audited, and the auditor is to say that the financial statements give a true and fair view. So the institute has clarified that, the council of the institute has clarified that unless the financial statements are prepared and presented in accordance with the applicable accounting standards, which includes the basic framework. If they are complied with, then only the auditor can say that the financial statements give a true and fair view. In converse, if the financial statements do not comply with the accounting standards, the applicable accounting standards, or they are not in compliance with the framework, then it will not be possible for an auditor to state that the financial statements give a true and fair view. In that context, I would say that the way the accounting standards apply to all non-corporate entities, similarly, the framework would also apply to the non-corporate entities. It is conceptually not possible that the financial statements can give true and fair view if they are not in compliance with the principles contained in the framework and the respective accounting standards.
Mohan sir, if there is a conflict between the conceptual framework and an accounting standard, then what shall prevail?
Okay, thank you, Nikita, for that question. But before that, let me do the initial part. Should thank, of course, Chairman of the ASB and Vice Chairman Abhayji for calling me for this program. And of course, absolute pleasure to share this platform with Manoj Fadnis sir, who I keep telling him this every single time. We had a great discussion on para 46A of AS11 when he was in Bangalore a long time back. So since then, we've been, I've been following him and he's been following me. It was a pretty, learned discussion we had on that. Aapko yaad hai, sir, when Bangalore we discussed this for para.
Oh, yes. Yeah. More than 12 years ago, but I vividly recall how para 46A was inserted somewhere in December 2011.
Sir, I remember even the date so well. Of course, at that time also he was a part of the. So absolute pleasure, sir. Thank you so much for agreeing to be a part of this program. Yeah, Nikita. So as the chairman and the vice chairman said, now this framework is providing you a sort of a foundation on which accounting standards are being developed. In fact, if you look at the purpose for which the framework has been established, basically the framework talks about three purposes. One is to assist the ICAI in sort of, prescribing accounting policies or in writing accounting policies and accounting standards, sorry. For as far as the corporates are concerned or the users of the financial statements are concerned, this framework provides them to apply consistent accounting policies, and to the general public at large to understand how accounting standards are, whether it can be Ind AS or it can be AS as the case may be. So this is the basic purpose behind this framework for this. Now, there can be limited situations wherein there's a conflict between the framework and the accounting standards which have been prescribed. Now, as I said, since one of the purposes of the framework is to assist the ICAI in writing of these accounting standards, it is obvious that the ICAI will take into account the fact that what are the measurement principles, recognition principles, all these mentioned in the framework. But the framework has been very clear that in case there is a conflict, in those limited situations wherein there is a conflict, it is the accounting standard which will prevail and not the framework. So that has been clarified by way of a clarification.
Manoj sir, it would be great if you could please explain the fundamental qualitative characteristics of financial information.
Yeah, that is very interesting. And just before that, if I can go back to what Mr. Lavi very vividly and very rightly explained, and I fully concur with him that there could be situations where there is something which is contrary in an accounting standard as compared to a framework. And as he said, the accounting standard would prevail. So in that context, I would just like to add to what he very rightly explained, and I fully agree with what he said, is that the framework contains the basic principles. Now, in a given situation, it may be essential to lay down a policy which is essential in respect of a particular set of a situation where that policy deviates from what is there in the principle. So just to give an example of extractive industries. So in case of extractive industries, there are certain principles which may be different from what is there in the framework. Now, Why they are different is because the extractive industries require a particular type of a treatment, and therefore the accounting standard specifically deviates from what is given in the framework. So we need to understand the framework as laying down the broad principles on basis of which the standards are developed. And in a situation where it is essential, the standard will depart from what is there in the framework and giving out what is the reasons why it has to deviate from the framework. In that situation, what is given in the standard will prevail over what is the general principles given in the framework. So as we have a maxim under the law that what is given directly needs to be followed rather than what is given indirectly. And in that context, the framework needs to be followed. But if a standard gives a different treatment, we need to follow the different treatment. Coming back to this question on the qualitative characteristics. So the conceptual framework brings out what are the characteristics of financial statements. So we agreed that the financial statements have a large number of users. So they could be the shareholders, they could be partners, there would be bankers, creditors, the tax authorities, or in case of listed entities, there are investors, existing investors, potential investors, future investors. So each one has a different set of information requirement. Now, for the financial statements, there are certain limitations. Now, the financial statements cannot give all the information which is required by all the users, but under a given situation, the financial statements, basis the relevant accounting standards, give the information which is generally required by the users in context of general purpose financial statements. Now, for the financial statements to give that information which is useful to the readers, the information contained, and as the framework says, what are the qualitative characteristics of the financial information? So the qualitative characteristics include the information should be reliable, it should be material, and it should be, so the information being contained needs to be consistently followed. So if you have an accounting policy and you consistently follow that accounting policy, in that context, that information would continue to be reliable. So relevance is what is important in context of the information which is being given in the financial statements. Normally, we say that we have different bases, as all members are aware. We have historical cost basis, we have fair value measurement basis, and it is said that under certain situations the fair value is more relevant, but at times less reliable, and historical cost is more reliable but may not be relevant. So there is always a trade-off between what is relevant and what is reliable. Now, relevance in the context of financial information would mean that the information should be useful to the readers. It should contain the information which the investors are looking at in terms of those elements. So if it is property, plant, and equipment, the information should be relevant in terms of what is the property, plant, and equipment, and similarly in context of income and expenses. Then the other important characteristic is that the information should be material. So materiality is not a yardstick which can be defined. It depends on situation to situation and case to case, industry to industry, it would differ. But materiality generally defined is that if there is an omission of a particular information, would it change the decision which a common, ordinary, prudent person would take? So basis materiality, what we understand is how it affects a common reader or a normal reader of those financial statements. So the information should also be material, and there should be a faithful representation and a faithful presentation of the financial information. So there should not be a bias. As I said, in case of listed companies, we have existing shareholders, we have potential future shareholders. Now, existing shareholder may like the share prices to go high so that he can sell at a higher margin, Whereas a potential investor may say, let the company show losses and the price may go down so that I buy the share at a lower price. The financial statements are neutral. The financial statements have to be impartial, whether it is an existing investor or it is a potential investor. So these are certain important characteristics which are what we say as the qualitative characteristics of financial information. Friends, let us also remind ourselves that there will always be certain limitations to the financial statements. So as we say, estimates. So estimates are essential part of preparation of financial statements, but estimates do not make the financial statements unreliable. Now, when we say depreciation, for example, we say the useful life is 15 years. Well, 15 years is the best estimate. It could be 10 years, it could be 20 years, it could be more or less than 15 years. So this is an estimate of the useful life, and basis that useful life estimate, the asset is depreciated. So these are estimates which are used in the preparation of financial statements, which add to some degree of subjectivity, but this is an essential limitation of financial information. But if the financial information contains the qualitative characteristics, as I mentioned, the financial information will be useful to the readers of the financial statements.
So if I may add qualitative character, we can also add another character, comparable.
Yes, it should be comparable, and that is why there are uniform set of accounting policies, and if there are differences, then they are required to be disclosed, so that when a comparison is being made, the comparison would bring out that difference. So as Mr. Lavi was referring to Accounting Standard 11, that paragraph 46A, where there is an option that foreign exchange differences could either be expensed off in the profit and loss statement, or they are capitalized as part of the cost of the asset. Now, under Ind AS, we do not have that option, but in AS, for a certain degree of time, that option did continue. Now, that once you have an option, the comparability is lost. But the comparability is brought out by the fact that what option is exercised is disclosed in the financial statements. So there will be different accounting policies being followed, and disclosure of what is being followed will ensure that there is a comparability, even if there are different policies being followed.
Mohan sir, there's this concept where it discusses substance over form. What do we mean by substance over form in this?
Yeah, Nikita. So I think I'll just add on to what Manoj sir was talking about, this qualitative characteristics, what you also mentioned. I think one good way to look at these characteristics is to see what will happen if those characteristics are not there. You know, if you think that this comparability or relevant reliability, faithful representation is not there, accounting standard statements can be presented in any manner they want. So you should have some certain, fundamental characteristics. That's why the framework has sort of, put in these fundamental characteristics there and sort of said that you'll have to follow this to the extent possible here. Well, see, Nikita, actually this concept of substance over form, somehow there seemed to be an impression that substance over form came only during Ind AS, which is actually incorrect. Even the framework for AS at some point of time had this concept of substance over form. Now, this concept basically says what Ind AS has basically done is it has increased it to a larger extent and provided more relevant examples of substance over form, of the concept of substance over form. Now, basically what they are saying is if you pick out a couple of those fundamental characteristics, qualitative characteristics which Manoj sir so well explained, say, for example, faithful representation. If there should be a faithful representation of a particular transaction, the framework is saying that you should look at its, don't necessarily look at its legal form, but also look at what is the substance of the transaction. And there is a very small example given in the framework wherein they said that suppose you have, extinguished the rights for an asset, but, the documentation is not still complete.
Still pending, yeah.
Yeah, you can still sort of, show it as a derecognized asset because essentially in substance the asset is not yours. Though in legal form, because title has not been transferred or some formalities have not been done, you are still, there can be a possibility that you are the owner of the asset. Now, Nikita, what has happened in AS, there were limited examples, but as I told you earlier, Ind AS has expanded the scope of substance over form to a large number of transactions. And they have said that this faithful representation, relevance, reliability, all comes from using this concept of substance over form. Now, the particular Ind AS standards do not specifically say, or the AS standards do not specifically say that, look, I am following the concept of substance over form here. But you can look at it from a perspective of saying that, say, for example, I'll give a couple of examples where you can attribute it to substance over form. Now, say, for example, this concept of classification of assets as per Ind AS. Generally, the classification of assets, we know that it is called as property, plant and equipment or fixed assets, as the case may be. But in Ind AS, what happens is that classification depends upon the use of the asset. If you are looking at it from the point of your own use, you show it as property, plant and equipment. If there's an unstated future use or for economic benefits, you show it as investment property. If it is for the purpose of sale, you show it as a 105 asset as held for sale. And the standards also permit transfers between these categorizations. The standard does not say this is substance over form, but in effect, what we are trying to say is that depending upon what is the transaction, you are holding a piece of land in Mumbai with no stated purpose. It will go and classify it as, investment property. And when you put in a purpose, it can come under any other classifications when you want to sell it or something. So this substance over form permits, as I said, a lot more in the Ind AS framework than in the AS framework. Though in AS framework also, in bits and pieces, they have mentioned this. And you would say, for example, the asset I told you about, sale and, if you buy back an asset, I sold an asset with an intention to buy it back in 6 months' time. What do you do in that particular case? It is very clear that you want to buy back the asset. So the agreement also says you have to buy back the asset. So in substance, the asset still belongs to you. You may not be able to recognize the sale transaction. So what this framework is basically giving us the guidance is look at the economic reality of the transaction than its actual, just the legal form. And you can expand this, Nikita, and Manoj sir can also obviously add in a lot more examples. You say, for example, the concept of significant financing component in India is 115. Now, this is a concept which not many people in India have got used to even now, if you ask me. But basically what they're trying to say is that in effect, there's a financing transaction. In substance, there's a financing transaction there. When you sort of, agree to get this financing component to deliver the goods after 2 years, you take the money in advance at a particular price. What is mentioned as significant financing component 115, that also to a certain extent is the concept of substance over form. So
like hire purchase agreements, you would say.
Yeah, to a certain extent, even hire purchase agreement also. So I think combined with the framework's wordings of substance over form and those individual accounting standards which specify how accounting, recognition, measurement, derecognition should happen, what would happen is that you would recognize these transactions only based on their, shall I say, use or purpose than their legal form or just the documentation which is behind this particular transaction. That should reflect the economic reality of the transaction. That, in essence, is the concept of substance over form.
So then, do we mean to say that it is not equally important to give importance to legal form as well? Say, as an auditor or as a prudent businessman, I've purchased a property, but the legal title has still not been transferred to me. In that case, how do I consider? Do I consider substance over form as more important, or do I consider the legal form more important?
I would not be able to put a mathematical number as to which is more important. But I think, Nikita, what you can do is, again, I'll use the word called substance only. But I think what you should probably think of here is that has the person extinguished his rights or has the person fulfilled his obligations, whoever the person who's given you the property? If he has extinguished his rights, right to economic benefits, right to receipts and all those things, obviously it will be considered to be a sale. It can be derecognized. But if he retains certain rights, I think then in that particular case, it cannot be done. So I think you would have to balance between this. It may be a situation may come wherein there could be a conflict between legal form and this thing here. But I think you would have to give a little bit more weightage to the substance than the legal form.
Probably here our judgment would come into play.
Yeah.
So can I just add to
Yes, sir, of
what,
course, of course.
Please, sir, please.
yeah, Mr. Lavi has described, and very rightly you brought out that example. If the property you purchase is not legally transferred to you, but in substance the property belongs to you. So you may also like to examine in such cases whether the property really belongs to a person or an entity if the legal title has not been transferred. So in context of immovable properties, the legal registration becomes a very important aspect. So when we really talk about substance over legal form, I think a better example, I mean, this could be a very immovable properties, could be a different set of situations. But if you look at as the example which was mentioned in context of Ind AS 115, and another example which comes to my mind is in case of preference shares. So preference shares, as we say, under the Companies Act, we recognize them as part of capital. Under the accounting standards, we recognize them and classify them along with the share capital and say this is the capital. But when you test it under the economic substance, it could be a debt. If it is refundable to the preference shareholders along with with or without interest, it could be in the form of a debt which is taken a legal form of a capital. So that is where the standard comes in and says that give importance to the substance of the transaction, that if it is a debt, if it is refundable to the preference shareholders, it is not equity, and therefore don't classify it as equity. It could be a hybrid instrument in which you split off between what is the equity component and what is the debt component. So there is a greater weightage, and I fully agree what Mr. Lavi mentioned, that even the accounting standards, AS1 also talks about substance over the legal form. But that concept has been further enhanced when we come into Ind AS, and therefore we have situations where instruments like preference shares get classified as debt and not necessarily as equity.
Sir, are there any similarities in the framework of financial statements under AS and Ind AS?
Yes. So as we have, as I said earlier, we have two sets of accounting standards. One is the accounting standards, which are now notified under the Companies Accounting Standard Rules 2021, and which are essentially applicable in context of the smaller set of companies, the unlisted companies, and also the non-corporate entities. And the second set of accounting standards is the Indian accounting standards. Now, both these accounting standards have a specific framework on basis of which they are issued. So we have a framework for preparation and presentation of financial statements, which was originally notified way back in July 2000. So more than 23 years ago, this was notified, and that becomes the basis on which the existing accounting standards are set out. As against this, we have the second set of Indian accounting standards, which are basis this conceptual framework. So very rightfully, a person may ask a question, do you have two different frameworks? Do you have two different underlying principles? And therefore, the question very rightly emerges is, what are the similarities and what are the differences between these two frameworks? I would put it this way, that if I were to look out for the areas of difference, I mean, one can point out 10 different differences between this framework and that framework. But essentially, let us bear in mind that the framework remains the same. One was issued way back in 2000 on basis of which the accounting standards have developed. And for very valid reasons, those accounting standards have some different principles as compared to the current set of Indian accounting standards, which are more based on this conceptual framework. But both the framework, if you look at what is the equity, what are the elements of financial statements, how do you, what is it that you recognize, how do you measure, what are the measurement bases, the underlying principles are the same. The underlying principles have not changed. What possibly has changed from our understanding point of view is As the business complexities developed, as the business became more and more dynamic and became more and more complex over a period of time, accounting standards, which we say are the grammar on the basis of which the business languages are written, the business transactions are translated into what is the financial performance and what is the financial state of affairs of an entity. So that grammar, that accounting standards, which is the grammar of business language for recording of financial transactions, that grammar has also evolved over a period of time. So what were the financial instruments, say 30 years back, and what are the financial instruments today? There's a lot of difference. But if you look at what is a property, plant, and equipment, and whether you say it has to be depreciated over its useful life, that concept remains the same. So whether you read the framework, which is for AS, or whether you read the framework for the Ind AS, the basic things are the same. The basic things do not undergo change. So you have a measurement basis of historical cost. There's another basis of fair value. Now, in a different situation, the fair value may be a better basis for measurement. And in some other situations like property, plant, and equipment, one may say that the historical cost is a better basis for measurement. So I would say that the essential characteristics of both the framework are the same.
Mohan sir, if you could please let us know what do we mean by the term unit of account?
Yeah, Nikita. Okay, so basically the textbook definition of unit of account is the right or a group of rights, obligation or a group of obligation, or a group of rights and obligations to which the recognition and measurement criteria mentioned in the framework are applied. This is the broad textbook definition given. And in fact, one of the things which is, since you spoke about the differences in the framework between, AS and Ind AS, I think the unit of account is more an Ind AS,
Concept.
the concept than the concept in, as Manoj sir was rightly saying, because you could have different measurement criteria for different units of accounts there. So I think that is the textbook definition which has been given there. Now you could break this up. See, I think I'm just trying to sort of, steer a little bit away from this discussion by saying that we should actually be a little bit grateful that the Schedule 3 is there for us in the Indian context, because it solves many of these problems of unit of account and all, right? I don't have to take the trouble of finding out what is my unit of account, what is my classification, what is my measurement. Schedule 3 does it to a large extent. But if you want to subdivide this unit of account into further units, say, for example, as I said, it's an obligation or a set of obligations, right, or a set of rights. You could have, say, for example, financial assets with a different set of rights, right? You could have intercorporate deposits which are not having a particular set of rights. If you want to further subdivide them based on this particular criteria, the framework permits you to do so. The framework permits you to do so. But at a very broad level, we always should be grateful to Schedule 3 for sort of solving many of these problems for us.
Making life easier.
Making life a little bit easier, though interpretation of Schedule 3 makes life tougher for us, but at least at the very broad level, it makes it easier for us.
And sir, how does the selection of unit of account help us in providing useful information?
And I think I'll fall back upon what Manoj sir also spoke about, this qualitative characteristics here, because see, if we are going to talk about, and just to all the participants here, just I wanted to sort of re-emphasize this point which Manoj sir said, that at many times we may feel that this framework, it's such a boring topic. Why are we talking about this relevance, reliability, and all those things? I am being very honest on this. The fact still remains that it still gives us a particular guidance. As we look at later on a few examples, we still have to fall back upon the framework. Now, when we speak about this concept of relevant, reliable, faithful representation and all these things, and if I look at this concept of unit of account, it is very clear that I can have as many units of account as I want, or as little as I want. So I can choose. I got the option. I can say these are my set of rights, these are my set of obligations. Too much of information, I think one of the requirements in the disclosure standard is that don't provide so much of information that the person who's reading the financial does not know what to do. or what information to, sort of read, where to read also, right? At the same time, this concept of faithful representation, and if you look at the substance of form, in fact, many of these concepts in this framework sort of talk to each other. They sort of actually speak to each other and say that if you are going to give a faithful representation, then your unit of account should probably not be too large, should not be too less here. So I think what is important for us is to find out the right balance and to seek the right balance of this unit of account. One example which I can think of, Nikita, is that, and this example also runs across for offsetting also. Suppose you have a contract, trade receivable and trade payable, right? You can have one unit of account for trade receivable and trade payable. Now the question always arises whether you want to show it together or net it off. And if I look at the concept of substance over form, faithful representation, if I look at all these qualitative characteristics of Ind AS financial statements, I would want to show them separately, just to sort of give a respect to
faithful representation.
However, if these transactions are interdependent, and I'm going to settle in net only, means, okay, I don't have to pay him, he doesn't have to pay me. At the end of a particular time frame, we decide that, okay, you know what, this is the net balance, I'm going to pay you this. There's a particular contract, and these are interdependent upon each other, both the supplies or services. In that case, you can have one single unit of account. This is what the framework also sort of gives us guidance here. Again, here, what we should probably be extremely important is, see, Manoj sir spoke about extractive industries. Say their units of accounts could be a little bit more different from what, say, for example, a normal software company could have, or a typical, manufacturing company could have. You may want to show that unit of account separately, only to keep this faithful representation at the back of your mind. So that balance has to be struck properly. That's what I'm trying to say.
And Manoj sir, what do we mean by the term measurement of elements?
So the elements, as we understand, are in terms of financial statements, we have the basic 5 elements: the income, expense, assets, liabilities, and the equity. Now, when we talk about the measurement, all these items for the purposes of the financial statements are required to be denominated in terms of their monetary terms. And therein, you have different measurement bases. So one is the historical cost, and second is where we use the fair value, the present value, and the current cost. So in a historical cost measurement basis, you decide what is the cost which was actually paid for the acquisition of that asset, or what is the value which is required to be paid for settling an obligation. So that is the historical cost. As against that, the other basis could be where you use the fair value. In the fair value, you find out what is the fair value of that asset or a fair value of that liability on the measurement date, and you accordingly value that asset or liability, or maybe an element of income and expenditure on the basis of that fair value. Then, separate from fair value measurement basis is where you find the value in use, the present value. So more particularly, if you are looking at what is the, if it is required to calculate what is the impairment on a particular property, plant, and equipment, so you find out what is the present value of using that asset, compare that with what is the selling price if you sell off that asset, and in that way you find out the value in use. So the other basis is where we use the present value. And the third is where you compare the cost with the current cost. So these are different measurement bases, and it is each measurement basis has a relevant use, and it is well codified in the framework as to what that measurement basis means. And then when you look at the qualitative characteristics and you want to give a faithful presentation of the financial information, you need to select an appropriate measurement basis for measuring a particular asset or a liability, and then that principle of consistency needs to be followed on a year-to-year basis. So measurement basis for different elements are given in the framework, and considering what is more appropriate under a particular situation, the preparer and the preparers of the financial statements are required to use a particular measurement basis for measuring these elements in the financial statements.
Continuing with the same question, Mohan sir, what could be the factors that we consider while selecting a measurement basis?
Yeah, so I think Manoj has already answered this question in his response itself. But yeah, I think it's important, Nikita, because you see, as we are looking at this various bases for measurement, and as he said, we've got fair value, we've got historical cost, we've got current cost, we've got VIU, the concept of VIU and all those things, right? Now, I think what is important for the preparers of the financial statements to understand and to choose, or what should they keep at the back of their mind when they choose a measurement basis, should probably be the nature of information which they are presenting in the financial statements. What is going to be the nature of information which they are going to, sort of present in the financial statements? See, the measurement basis, once you have an option given by a particular framework, saying that, okay, you have got these 4 measurement bases. Now, the entity is at liberty to choose something which suits their appropriate requirements, provided, again, of course, as Manoj rightly said, all the requirements of the framework qualitative characteristics are still met. I mean, that is the underlying. You cannot deviate from that particular aspect as such. Now, since sir was mentioning about impairment, I'll take that as an example. You take this impairment as an example. And we have, even before we enter into the accounting standard for impairment, which is pretty much the same both in the AS as well as the the Ind AS framework. Basically, what the measurement basis for an impairment would be, depending upon these various measurements, what would it reflect in the financial statements? You take, for example, the concept of fair value. As we know, the fair value, the value in use, carrying cost, all these are the basis on which an impairment is done. If you are using the measurement basis of fair value, the impairment would reflect the changes in the fair value in the profit or loss account. That's what an impairment would probably, using the measurement basis of fair value would choose that. But in case you're using, say, the concept of value in use, which Manoj sir so articulated so well. Now, I am doing this on the basis of my cash flows. And I'm doing this on the basis of my cash flows and attributing it to a particular set of assets, and then looking at the carrying amount and all those things and doing these things. Changes in that measurement basis of value in use. In case you're using a VIU concept, the changes would also be reflected in your profit or loss accounting. But then you could probably ask a question, and many members could ask this question. In this case, what happens to my historical cost? Because as Manoj sir rightly said, see, sometimes what happens, we feel that PP historical cost is the best. Because we have the asset, we bought the asset, we know when we bought the asset is being depreciated on a very regular basis, and it is giving us economic benefits here. The concept of historical cost is pretty much well known in this thing. When would you revalue that particular asset, or when would you fair value the asset? Only when you feel that the economic benefits are substantial or it meets this particular requirement. What about the measurement basis for, let us say, for example, if it's at historical cost, what would those changes in the historical cost, reflect in? I'm talking specifically only about impairment, because I'm not talking about fair value, I'm not talking about VIU, I'm not talking about anything else here. What happens if you feel that the asset was being carried at, historical cost, but there's an impairment and you're using this measurement basis of historical cost? What it means, Nikita, is that the historical cost is no longer recoverable. Even without looking at the concept of fair value, VIU, current cost, replacement cost, any of these things, if I'm doing this in measurement basis only on the basis of historical cost, there is a very clear, statement that historical cost is no longer recoverable. That is why impairment would have to come into this picture. So, to sort of summarize the response, what we need to consider is what is the nature of information being provided in the financial statements. Number one, underlying qualitative characteristics should never be vitiated. On that basis, you can choose what is your measurement basis. whatever the measurement basis the entity wants to choose for the unit of account, they're free to choose it.
So it's at the discretion of the management and not the auditors.
Thankfully, as of now, it is.
Right, sir. Since we are already touched upon the recognition concept, so Manoj sir, how would we recognize assets and liabilities as per the framework? I'm sure this is a continuing question to what we've already discussed.
This, of course, what basis to select, as Mr. Lavi also very rightfully explained, and you agree, you said it, is that it is for the management to decide and management to take into account what should be the basis, for the very obvious and important reason that the responsibility for the preparation of the financial statements is of the management and not of the auditors. And therefore, in the judgment of the management, what is the appropriate basis has to be decided. In case the auditor disagrees with the view taken by the management, the auditor is free to issue a separate qualified report. But the judgment has to be that of the management, because the management knows better what is the useful life of the asset, what are the obligations which are there, which is required to be settled at what point of time. And when you're calculating your present value in use, as very rightly mentioned by Mr. Lavi, it is for the management to decide what is going to be the free cash flows in future, basis which you decide and you arrive at the value in use. And therefore, the framework and the accounting standards always give that right and the obligation to decide to decide what should be the appropriate measurement basis or what should be the appropriate accounting policy. That responsibility is always on the preparers of the financial statements. Having said that, as you said, how do we recognize an asset or a liability? Now, any financial statements or any accounting standard would give us certain basic principles, and those basic principles are recognition principles, measurement, presentation, and finally the disclosures. So in context of, let us say, property, plant and equipment, when do I recognize the property, plant and equipment? What is it that I can recognize as an asset? In context of a property, plant and equipment, it could be very simpler and easier to understand when to recognize a PPE. If you have purchased a PPE or you have acquired it or you have self-constructed it, you can see and feel and touch that asset, and recognition is not so difficult. But let us look at intangible assets. Intangible assets which are being developed. Now, there is, as the standard tells us, there is a research phase, there is a development phase, and there is a different accounting treatment under the different phases. So, when do you recognize an intangible asset? Or when do you say that the intangible item is no longer an intangible item, it is an intangible asset? So the recognition principles contained in the standards would give very clear guidance both with respect to assets and liabilities. So asset, we say, is a resource. It is something which generates future profitability or gives certain enduring advantage to an entity. And that is what you recognize as an asset. And then you depreciate that asset over its useful life if it has a longer useful life. So in context of financial assets, like say receivables. So when do you recognize a receivable? So receivable you would recognize when you have sold your assets, you have sold your inventory, and you have established a right to recover that money from the debtor, and then you call it as a trade receivable. So asset is a resource which is controlled by the entity. And if these characteristics are being complied with, then you recognize an intangible asset or you recognize an asset. In context of intangible assets like software development, or a common example could be a lot of expenditure incurred on training manpower. Can I recognize that as an intangible asset? So the standard gives, and the standard and the framework would give what could be the recognition principles for recognizing an asset. And similarly, in context of liabilities, when do you recognize? And similarly, and taking a step forward, when do you de-recognize a liability? Do you have a continuing involvement with that liability? So these are the basis, the principles which are given in the framework, which help you in recognizing an asset or a liability. And similarly, when do you recognize an income or an expenditure? And basis that you recognize, and then comes the measurement principles. After you recognize, how do you measure it? And when you measure it, how do you present it in your financial statements? And what are the corresponding disclosure requirements, which would be essential to make that information more relevant to the users of the financial statements? So in that context, one needs to understand the recognition principles.
So with this measurement concept, can we have different bases for measuring of an asset and that for a liability?
So whatever basis is adopted is required to be uniformly followed. Now, in case of assets, as under Ind AS, it is more well defined as compared to what was there in context of AS. So you had a situation where property, plant, and equipment was being measured on historical cost basis. And in one particular year, the entity might like to come out with for some reasons, would like to revalue those assets. And having revalued the assets, then continue to depreciate that revalued number over the remaining useful life. So this is what was typically happening in our old AS 10. Before that, AS 10 was revised in lines with the Ind AS 16. And today, the revised AS 10 and the Ind AS 16 are parameteria, I would say, very close to each other. Now, in the earlier situation, what was happening is, suppose I have acquired an asset in 2010 and I have come out with, say, a public issue in, say, 2015. My asset was acquired for, say, for just giving a number 100, I revalued to 150 in 2015. And then from 2015 to 2023, I'm depreciating that 150 over the remaining useful life of that asset. So in 2023, if you are to look at that asset and ask a question, whether it is on historical cost basis or it is on a fair value basis, and you will say the answer is none, because it is not the historical cost what you acquired in 2010, and it is not the fair value as of today. It is the fair value as of 2015, depreciated from 2015 to 2023. To mitigate that kind of difficulties or that kind of anomalies which had arisen in the financial statements, now AS 10 mandates that if you revalue, you need to continuously follow the revaluation model. So what the standards would permit is, if you have a property, plant, and equipment, or any tangible fixed assets, so to say, that class of assets should follow the same basis. So the class of asset could be land, building, plant, and machinery in that sense. So if, say, land is being fair valued, then all categories of land should be on fair value basis. Or if buildings are being fair valued, all buildings in that entity should be on fair value. You can't say that my building in plant A, I'm going to carry at historical cost, and my factory building in plant B, I'm going to fair value. That will distort the financial information. That will not make the financial information reliable and relevant. But yes, a company may say, I will depreciate all, I will measure all my factory buildings or a category of plant and property, plant and equipment on fair valuation basis, if that fair valuation basis will give a better true and fair view of the financial position. So a type of an asset, you can have a particular basis for measurement, and for a different type of an asset, you could have a different basis for measurement. That is permissible under the standards. But and similarly, in context of liabilities, the liabilities would under a historical cost basis, you follow for liabilities under financial standards, where it gives better guidance than what is available under under AS, where you have either it is at amortized cost, or it is being measured at fair value through profit or loss, or fair value through other comprehensive income. So where it is being measured at cost, and the technical term used is measuring the liabilities at amortized cost, because if you have any upfront fees being paid, you don't recognize that fees as a cost, but you spread that fees over the life of that liability. So for a particular type of assets or a particular type of liabilities, the same method, the same measurement basis needs to be followed as compared to another type of an asset or liability which could sit in a different category in the balance sheet.
So to sum up, a class of asset can have a similar measurement factor, and whereas the other class of asset can have a different measurement factor.
Yes, yes. And at the same time, the management's responsibility to ensure that the measurement basis is not on the basis of their whims and fancies, but on the basis that this particular measurement basis is the most appropriate measurement basis for that particular asset or liability, given the kind of business models or given the kind of industry in which that entity operates. And that basis would then, that measurement basis would be consistently followed from year to year.
Mohan sir, will it be any different for us to recognize income and expenses as per the framework?
It would not be different, but I'll just answer that in a bit, Nikita. I'll just sort of add on, with Manoj sir's permission, I'll add on to, I'll give a, I'm actually going to ask you a question, Nikita, more than, putting a spot here. See, this recognition criteria, and also, since we spoke also about the fact that you could have measurement criteria also different, I always keep giving this example. So with your permission, just give me 2 minutes, I'll explain this example to you. You take, for example, many large defense companies in India, many large defense companies who manufacture, say, for example, helicopters or very, large defense equipment. These are pretty costly items. So what they do is that, they have certain capacities to, manufacture a certain number of defense equipment. Some of the equipment required to manufacture these helicopters are quite costly and not available so easily in India. So what the Ministry of Defense does is that it orders these machines to manufacture these helicopters from, say, abroad, wherever it is, giving instructions to the manufacturer to deliver those products to the, say, for example, HAL, for example. You can take an example of HAL, which manufactures helicopters. The Ministry of Defense places the order. The Ministry of Defense has to pay that person in Germany or wherever he is. But the machine comes to the complex of the HAL or the factory of the HAL and is used to manufacture those helicopters for, let us say, 3 or 4 years. And the contract says that at the end of 3 or 4 years, you can do whatever you want with the machine. You don't have to give it back to the Ministry of Defense does not see that machine, does not want that machine. They have no use for that machine. This is a typical example which, we can use. Now, the first question I'm going to ask you, Nikita, is that, can this defense company show it as an asset in their books?
Now it has no economic use to them.
They're getting revenue, They're getting revenue from it, right? From manufacture of helicopters, they're getting revenue from it. Economic benefit is there. Physical presence is there. Physical possession is there. The only thing they don't have is title. Title is with the Ministry of Defense. At the end of the 4th or 5th year, whenever they manufacture a batch of helicopters or whatever this equipment is, the machine can be sold off, used for any other purpose. It never goes to the Ministry of Defense at all. So, considering what Manoj sir has been saying about recognition measurement criteria, is there this element of control which they have got? Or do they have temporary control? Can they show this as an asset in their balance sheet? If they show it as an asset, what measurement basis they have to use? I think these are the questions we have to answer. Now, obviously, what this company is actually doing, they're showing this separately in their balance sheet as customer funded assets. They have a separate category called as customer funded assets, not mixing it with property, plant and equipment and other things. And they are saying that this is customer funded assets. The way the transaction is settled is from the amount which the Defense Ministry or whoever has to pay to them, they set off this particular value of this particular asset here. Now, whether it meets the definition of an asset is the one question we'll have to, because we always keep asking them, what control do you have over that asset? Do you really have, just physical possession may not necessarily be equal to control. But they are saying that you look at my contract, it never goes out of my premises. I'm going to use it. I've got economic benefits from this. to a certain extent, I've got control because at the end of the third year or fourth year, I can decide what is to be done.
So would it be a comparable transaction, like we would say that we get leasehold rights for a land for 99 years? So
Yeah, something of that sort. But I thought, of course, I'd take Manoj sir's concepts also, values, inputs also into this. But I think what is important here, can they fair value this asset? We speak about the recognition, assume that they have met all the definitions of control, they met all the definitions of possession is there, economic benefit is there. Can they fair value it? Is a question which, and since you spoke about measurement basis, I thought I should bring this example. In my opinion, probably they should not be fair valuing it because of the fact that it's got a limited use for them. They may not be able to actually fair value this particular asset. But I'll answer your question about income and expenditure, and then I'll hand it over to Manoj sir for his inputs on this. See, income, basically what the framework says is that there should be an increase in the asset or a decrease in the liability that results in an increase in equity. And the opposite is therefore expenditure. Decrease in asset or increase in liability that results in a decrease in equity. This is again the textbook theoretical definition of income and expenditure here. What members and participants should understand is we are not talking about revenue recognition here. We're not talking about revenue. Revenue is only one concept of one component of income. Revenue is coming from the revenue standard. Revenue definition is coming from the revenue standard. Here, what the framework is trying to say is that so suppose we have a situation wherein we need to decide whether this is income or not. We will have to use this definition to say whether there's been an increase in an asset or a decrease in a liability that results in a corresponding increase or decrease in equity. I can give one example, Nikita, for the purpose of the participants here. You take a company like Amazon. Amazon, what they do is they onboard a lot of suppliers onto their platform. Now, suppose many of the suppliers want to say, display their mobile phones, garments, you name it, whatever it is, right? Previously, Amazon was bearing the cost of those photographs. They have got a particular criteria. This quality should be there. You should have minimum 4 photographs and all those things. But, people used to give different types of photographs. So what Amazon did was they said that, look, we will do the photographs for you. We will got a set of photographers on our panel. They will take all your products. They will upload it onto the platform. But whatever the photographer charges, you will have to reimburse that particular fee, or you will have to pay that particular fee. We're not going to bear that cost. If he charges 5,000 rupees, that 5,000 rupees will have to be borne by you for onboarding that into the platform. Again, for the participants, I'm not talking about revenue here, I'm talking about income. If I look at the textbook definition of income, it says that there should be an increase in the asset or decrease in a liability. Assuming Amazon does apply this principle of increase in an asset, this money they have to get from this person whom they are onboarding, the supplier whom they are onboarding, results in an increase in the asset. Is revenue represented net, we'll come to, we'll discuss that later on. So this is the basic concept, not very much different from what we have seen from what assets and liabilities Manoj sir spoke about. But I think what is important for us to understand for the item of this on a transactional basis, results in an increase in the asset or a decrease in the equity, or a decrease in asset, increase in equity. That sort of a correspondence or that sort of a link will have to be made to understand whether it is income or expenditure to be presented in the in the P&L account. Whether how to classify it will come separately. It will depend upon the individual accounting standards will drive that.
right, sir. And sir, would it be any different for recognition criteria in case of control and rights?
Control and rights would also largely be the same.
Yeah, and like you've already discussed that it belongs to the ministry.
Yeah, whether I lose, whether I possess control or I lose control, that event would decide whether what is to be done for that particular.
So that was a very interesting example which you gave with respect to defense equipments being acquired by companies where the ownership continues to remain with the concerned ministries, and these are the typical questions which could pose challenges unless one falls back on what is there in the framework and the standards to understand what would be the right accounting policy to describe that kind of a transaction. So the terminology, as you mentioned, is customer funded assets, not forming part of PPE, but being shown separately. So that is what really gives the faithful presentation of the underlying transactions. And I think that very adequately and very nicely brings out the concept of substance over the legal form, and the economic transaction or the economic substance of that transaction is more important than what is the legal form. Another such example which comes to my mind is in case of, say, toll roads and airports and bridges which were constructed using toll rights. So before we had Ind AS 11, and now which is part of Ind AS 115, under AS, we did not really have any guidance as to what should be the accounting in case of airports and bridges and such infrastructure projects as to what should be the right accounting. And therefore, we had situations where the airports would come and sit in the toll companies' balance sheets, or bridges and roads would come. Whereas what the company had was a right to collect the toll and not a control on that asset. So if a company has constructed a road and on that road it is collecting toll, so it does not have the ownership of the road. And therefore, it was not right and appropriate to show that road as part of the asset. And what was required to be reflected as part of the asset is the right to collect tolls. So I think that is what the Ind AS brings out more specifically the requirements in context of this changing manner in which the business transactions take place. And therefore, the more and greater importance on substance over the legal form, I would say.
Thank you, sir. Thank you so much, sir.
It's one example which is covering everything. It is covering the recognition, the economic use, the right substance over legal form. So I think the example very well covers.
Just to add on to what Manoj sir said, Nikita, in fact, I remember this in 2008, 2009, sometime around that time, when IFRS was being permitted, this Delhi Noida Toll Bridge Company, right? They chose to do only one IFRS, not the entire set. Manoj sir will remember this very well. They only wanted to do revenue recognition. They did not want to do, as he said, the right to receive the toll. And because you will have to put a useful life for that. That time, Ind AS was still not, completely formed.
Yeah, 2008, it was not even born.
It was not even born. They chose to implement only one IFRS, not the entire that service concession agreement. That actually was more an IFRIC than an IFRS. They chose to implement.
Yes.
So it was management discretion.
Yeah, actually, management discretion, correct.
Yeah, but with the responsibility to ensure that the financial statements give true and fair view.
Right.
True and fair, that also is there. No, correct.
So if you could throw some light on the concept of capital and capital maintenance.
Yeah, okay. So again, as we've been discussing, Nikita, what happens is that we spoke about income, we spoke about expenditure, we spoke about assets, we spoke about liabilities. Now, actually, what remains after this is only capital. What remains after all this is over is capital. And I think basically what the typical accountant's definition of capital, if I may use the word, is basically what is assets minus liabilities will ultimately end up in being your capital here, right? And see, the framework very interestingly uses this concept of capital maintenance. We have not actually heard of this concept of capital maintenance. I mean, we know about distribution of capital by way of dividends and all those things. That is something which is more like a management concept, how you distribute capital by way of dividends and all those things. And again, the framework talks about this fact of capital and capital maintenance in two different sort of categories. They talk about what is called as a financial capital, and they talk about something called as a physical concept of capital.
Yes.
They have a financial concept of capital and the physical concept of capital. The financial concept of capital is what all of us know. your net assets or net worth, as they may be, reserves and surplus, share capital plus reserves and share capital plus free reserves, net assets minus net liabilities. You can have various
permutations and combinations to it.
Combinations around that. What is that concept of capital? But that is one portion of what very interestingly, the standard on the physical concept of capital talks about looking at something called as productive capacity per day, for example. You can have number of units you're producing per day. Now, this again, the framework has brought in this concept and said that you could have either a financial concept or you could have entities are free to have what is called as a physical concept. It is very clear, Nikita, that what will happen is the physical concept will have a financial implication. End of the day, even the physical concept of capital which I'm having will have a financial implication in terms of, it may ultimately go and sit in my reserves and surplus. It may bring in some further equity to me and all those things. But I think the idea, what they have, tried to say is that when they spoke about this word called as financial capital maintenance, what they're basically saying is that financial capital maintenance means the net worth or the financial assets at the end of the reporting period should be more than what it was at the beginning of the period. So they're actually basically talking about an increase in your net worth.
Increase in it.
They're basically talking about increase in your, and that they have mentioned is the basic concept of your financial capital, financial capital maintenance. Interestingly, they've also spoken about physical capital maintenance also. It said that the amount of units you produce, productive capacity at the end of the year should be more than what it was at the beginning of the year. So in both of these concepts, they have used this concept of capital maintenance, capital as well as capital maintenance. But I think what participants should understand is that since we are, and I told you earlier also that there's a link between these various concepts in, this framework also. We don't have to go to the accounting standards. We don't have to go to the Ind AS for this. If I look at the bare bones of the framework, if I use my assets, recognition measurement criteria, liabilities, recognition measurement criteria, what we have discussed till now, look at the concept of what is my income, what is my, what is my expenditure, and I follow the framework in its true form for all these aspects. What remains would only be physical capital or financial capital. What remains other will actually be a financial capital.
So can we have another example for physical capital?
Physical capital, I can think of car companies, many car companies I can think of, wherein they have number of units per day, they have, number of units per day, they manufacture based on number of units per day, their recognition or many of their criteria is also based on units per day also, or how much they're producing per day. And that results in a certain revenue recognition that results in a certain, amount of the financial statements. You can use many of these concepts. Now, the idea is that they are basically talking about the capacity to produce, which may result in a financial benefit. Result in a financial benefit is something which I am adding. They are basically talking about how the concept in the framework speaks only about what is a physical capital. That's all. It does not talk about the link with the financial capital. But we know from a practical example that because entities may want to use that as a basis. Now you look at startup companies, there's a number of hits per day. There's a number of
whatever the market share,
gross merchandise value, number of repeat customers. All these are, non-financial metrics which could result in a measurement basis for them, but that could have a financial implication at some point of time.
That was a perfect example of the startups. So we've also touched upon derecognition. So what is the concept of derecognition?
Okay. I think, again, this is a good question, Nikita, again, and it's very nice that you brought this out at this point of time because see, basically what we have got used to in AS was scope, recognition, measurement, disclosure. All our standards were built that way. And nothing wrong with that. But what, as Manoj has also been repeatedly saying, Ind AS gives us further clarity on this. In Ind AS, what we are trying to do is scope remains the same. Recognition can be initial and subsequent recognition. Measurement can be initial and subsequent measurement. But I think what has basically been a sort of a lot of importance has been given. A lot of these India standards is this concept of derecognition. Now, just as we speak, like Manoj sir was saying, when I'm talking about asset, I am saying about control over the asset. Right? And we've also given a couple of examples wherein, control may not be there or control may be lost and all those things, right? So basically what the concept of derecognition is saying is that removal of this particular asset or a liability from the balance sheet of the entity. So basically what it means to say is that I have lost control in case it's an asset. I have no economic benefits I'm going to get from that particular asset. If it is a liability, I have got no obligation to pay. Or my obligation has been extinguished because I've settled it, I've paid it, or it has been waived. In fact, I can give you an example which I keep giving in many cases. This happened again in 2009. And I'm drawing this on the US, as all of you, as all the participants also aware. Suddenly they said, recession and the global recession, credit crisis. They said, some mortgage crisis and all those things. The good thing about all this, Nikita, is for India, it doesn't affect us at all. We'll continue going back and doing our work tomorrow morning. Manoj sir will continue to be in Indore, I'll continue to be in Bangalore, we'll do our work. Now, one day what happened, suddenly in 2009, somebody said recession is over because 2 banks in the US have reported profits. Now, again, people were very worried. They're saying, how is it possible that 2 banks reporting profits? They're saying global recession is over. So the response was, these are the banks who made the recession in the first place because they were the people who gave all these housing loans.
Yeah.
And I think the Citibank and Goldman Sachs, if I'm not wrong. So people saying, how can these banks show a profit when, they had a long history of losses? So there was one journal entry they passed, both these people, by which this loss became a profit. Derecognition of liability. What they were basically saying was, they had this US government as their creditor. They went to the US government and said that, look, I'm in a very bad shape now. I'll not be able to pay you. Can you waive my debt, which I owe you? US government said, okay, you can waive it, no problem at all. So what they did was, liability is no longer payable, written back, and those amounts were in some billions of dollars, went to the P&L account, the liabilities are knocked out from the balance sheet. I'll use this as a derecognition criteria because what they were saying is that my obligation to pay is not there. My obligation to pay is not there, so I'm derecognizing it. Similarly for an asset also. My rights to receive, economic benefits, control, all 3 have been lost, I will derecognize it.
So, it's a very nice example that, it just extinguished all its right and it converted its
example.
Yeah, it converted its losses into profit and the entire economy got affected with it.
But again,
So-
I'm telling you, Nikita, I can tell the participants, again, they can relate this with all what we've been speaking for the last 1.5 hours, the relevance, all these concepts, they can think of it and they can relate to it actually.
Yeah, so the next 2 questions, is a question that we often come across while we are signing the financials or conducting our audit is, when can debtors be written off or when can we write back our liability, ideally that's what, we de-recognize them in the books, but we don't realize it at that time. And somewhere even the management feels that, I'm not going to recover this amount, so it's time for me to de-recognize it. But is just that concept okay for us to de-recognize an asset, or do we need something more to it?
Okay, the way I would respond to this, Nikita, is that I will still say that please go by what the framework says. We are talking about derecognition, we're not talking about a provision here. So there are 2 different things. We're not talking about a provision. When you're talking about a derecognition, we're talking about the fact that it is removed completely from the balance sheet.
Yeah, then we write it off.
It's a complete write-off. So there, I would still think that what the management has to do is that they should really go back and think whether control has really been lost or do they retain a certain portion of control. Now, if you look at, say, for example, trade receivables, or you look at even a housing finance company, right? The housing finance company, their main job is to give housing loans and collect the EMI on those loans for the purpose of their operations there. Now, what this housing finance company can possibly do is that they can securitize these loans. They can give it to an ARC. They can give it to another company and say that, are you willing to take these loans for, from my balance sheet? In fact, the credit crisis we spoke about, that's exactly what happened. Lehman Brothers was the last bank holding the baby. It started from, some Bank of America some many years back. So what happens there is that there are two types of things, Nikita, here. One is what is called as recourse factoring. One is called as non-recourse factoring. In the case of a non-recourse factoring, control is lost. So any risks which the ultimate or which suppose the person does not pay, the borrower does not pay, the risk also is transferred to that ARC or to that particular company who has bought this asset. In that case, the housing finance company has got all the rights to derecognize asset because the definition of in the framework also is met. Control has been lost. Economic benefits are not there. So they can derecognize it. But suppose they retain some element of control. Say, for example, in the recourse factoring, the ARC will say that, look, I'll wait for 6 months or 8 months. If he does not pay, I'll come back to you only. I'll push it back to him. I'll push him back to you only. In that case, I think still that risk is there. The responsibility is there. Economic benefits have not been transferred. So in that case, derecognition cannot happen. Derecognition cannot happen here. So we would have to look at whether my right to receive has been completely ceded, cancelled, or extinguished. Similarly, in a liability situation, whether my obligation to pay has also been extinguished, annulled, or cancelled. You take, for example, many of the cases which are there in the insolvency and bankruptcy code, wherein I get a particular order in my favor, taking a haircut and saying that, okay, I got to pay you some X amount of money, I get for a settlement. The committee of creditors agrees for a settlement. That would amount to a derecognition because I don't have to pay it. That obligation has been extinguished. What the management should be very clear about is that this criteria would definitely have to be met. Again, okay, you can say estimate, judgment, basis, all this will definitely come into play. But this underlying thing would definitely have to be met. If that is not met, I do not think they should be able to derecognize it.
Think we'll have any exception to this concept?
Exception to this concept, well, I do not know. I can't think of any particular exemption as such. But again, if you look at it, I would only fall back upon the framework, Nikita, for this answer. I'll go by faithful representation here. That
So we have a question from the audience to this itself, that what are the legal consequences if the amount of the creditor has been written off?
What are the legal consequences if the
amount of creditor has been written off? See, that's why I told you that this question is going to interest a lot of people. We, in a normal course, we write off our debtors, we write back our creditors, but we sometimes don't realize the implications that they may carry.
No, so I think, see, again, that's a good thing that this question was asked at this point in time itself, because on what basis have you derecognized it? I think that becomes important, Nikita. You can't just, it's not a journal entry, right? It doesn't happen through a journal entry. See, the US government, Citibank did it on the basis of the fact that they had a letter from the US government saying that I will waive my right to receive this loan from you, right? So in the case of a typical situation, you will be able to have, say, for example, correspondence with the creditor or correspondence with the person, and he agrees. IBBI case is a good case. You're doing it on the basis of an order. On the basis of an NCLAT order, you're doing it. So I think that it is very important for us not to rely upon the fact that I can just do it at my whim and fancy, but there should be an underlying transaction, or there should be an underlying document which says that you've got or you've extinguished your obligation, your right to receive has been extinguished. Only on that basis can do. Otherwise, it can have severe legal consequences.
No, I fully agree. And if I can just join in on this point.
Please, sir.
See, writing off sundry creditors, and the principle remains the same, that there should be an extinguishment of your obligation. So the extinguishment can be by way of a contract, can be by way of a statutory order, there should be some legal extinguishment of your obligations. And if your obligations have been extinguished in letter and spirit, at that point of time, you write off the sundry creditors. Now, one could be that there is, say, some trade payables, and those trade payables, there is a dispute going on between the creditor and the company, and the company estimates that this is the amount which I need to pay. And therefore, you only quantify to that particular extent and not the full amount which is being asked for. And therefore, what we have is what is a liability and what is a contingent liability. So contingent liability does not enter into the financial statements. It is shown as a disclosure to the financial statements. So I think those principles need to be kept in mind. So if you have written off your creditors and you still have a legal obligation to pay the creditors, then I think the auditors and the management should ask themselves the question, was it right to extinguish that creditor when you had a legal obligation to pay that creditor? And one of the very common examples which I come across many a times is that are the creditors which are more than 3 years old, are they time barred? Can I write off those creditors? Maybe in tax assessments proceedings, the tax authorities may like to consider them as a possible, waiver of your credit, of your debts,
Liability.
and therefore it may be considered as income, but for the tax purposes, but not for the purpose of your financial statements. So merely because the creditor is 3 years old does not give the company a right to write off that creditor. There should be a proper extinguishment of your obligations. This is what the requirement, both under the accounting and the law, would require the company to ensure.
Manoj sir, I've seen an ECL model which said that trade receivables about 3 years on a case-to-case basis, ECL model. On a case-to-case basis, there's no format. I mean, that matrix has not been put for that term.
So we have a question on the same lines, that if a doubtful debt of a related party is converted into a bad debt and the auditor is not satisfied with the documentation, so as an auditor, can he qualify the report?
That would depend upon SA 700. He has to follow SA 700 on that. I will not be able to answer that question here in this platform. But I think who was asked that question, I think you would need to exercise a lot of caution here because, and I'll put this in a very broad context. If you want to report it in the audit report, today you've got a lot of paragraphs. You've got emphasis of matter paragraph, you've got key audit matters. You can choose other matter, you can choose any of these things here. Please go to that respective essay and see that, that appropriate essay has been acted upon and you put it appropriate in the audit report. It is not just a question of qualifying for the purpose of qualifying. You would have to follow that particular essay and see what is, see, all disputes cannot end up in the audit report. Then the audit report will become only a qualification. All the disputes which you have with management cannot necessarily end up in audit report. So you have to discuss this with them. If the amount is material, it's a sort of a thing which meets the definition of, say, an EOM paragraph, other matter paragraph, or even, for example, a key audit matter. I think you would have to use the appropriate paragraph in that essay and then report it accordingly.
So, quite agree with what you say in terms of ensuring compliance with the respective standards on auditing. More particularly, if it is a case of a related party transaction and there is a bad debts being written off, there has to be an adequate audit evidence available to justify that a receivable being written off as bad and doubtful debts. Making a provision does not mean writing it off as bad debts. But if debt is being written off as bad and doubtful debts, I'm sure that would require greater considerations from the auditors and the management to justify the correctness of that write-off. As very rightly said by Mr. Lavi, one needs to look into the facts and circumstances of each case and deal with it appropriately in light with the corresponding, it could be SA 700, 705, 706, emphasis of matter or qualifications. So in fact, a modified opinion could be a qualified disclaimer or a negative opinion. And if the auditor does not get suitable evidence and it is a material amount affecting the pervasive nature of that qualification, then maybe not just a qualification, but a disclaimer or a negative opinion will be issued by the auditor.
It depends on how serious that particular matter is.
Yes, yes.
Of course, the concept of materiality.
Of course, yeah, materiality also, yeah.
And the materiality, very rightly.
Manoj sir, you had touched upon this concept of value in use. So we have two concepts here, value in use and fulfillment value. Can you please tell us about both these concepts?
Yeah, the very interesting value in use. Normally, what you consider as value in use is, as Mr. Lavi also explained that while you was dealing with the impairment provisions in relation to property, plant, and equipment, you find out what is the present value of your future cash flows, and what is the value if you use that asset over its useful life. What are the cash flows you are going to generate, and what is the present value of those cash flows? That value you compare with what is the value you may get if you don't use that asset over its useful life and you sell it off immediately. What is the amount that you get? So higher of the two is what we say is the value in use. And if the value in use is less than the carrying cost of that asset, that is the point of time when you come and make a provision for the impairment. If the value in use subsequently has increased, then you can even write back that impairment provisions as permitted in the respective standards. Fortunately, on this subject, both AS and Ind AS have very similar positions with respect to how the impairment provisions are to be computed and made. So value in use is when you're finding out the today's fair value in place of what is the historical cost, as very appropriately described by Mr. Lavi when he explained this earlier. And fulfillment value is what is the value you in context of your liabilities. What is the liability what is the value you expect to pay to discharge your obligations or for the purposes of settlement of your liabilities. So value in use and fulfillment value is more in terms of fulfilling your obligations to settle a liability. What is the value that you expect to make a payment thereof?
Mohan sir, this framework also discusses on enhancing the qualitative characteristics, but at the same time, it also emphasizes on the cost constraints. So, should we overlook the qualitative aspect while doing a cost-benefit analysis?
May not necessarily be in all the cases, Nikita, because I think, see, one of the things which the framework, especially for Ind AS, has been very particular about is the fact that the costs of implementing anything should not exceed the benefits we're going to get from this. I think this has been the theme across many of these Ind AS standards and the framework and all those things. So if you look at the fundamental characteristics which we have been discussing about, say, comparative understandability and, even verifiability, and use the measurement basis, for example. I can give an example, or let's say the concept of fair value, which was limited in AS, but it has become more, extensive in Ind AS. Though, see, honestly, I believe that, see, the concept of NRV, the concept of, even VIU also, they are nothing but sort of fair values. We are not using the word called fair value there. Your NRV and your inventory standard is nothing but a fair value. But what Ind AS has done is done it on a more larger scale, especially to financial instruments, because we did not have a historical standard for financial instruments. So I think that's what Ind AS has done. But let us assume that the concept of fair value for financial instruments I'm taking, I think why this cost constraint has come in, Nikita, is that how far back in time can you go to get this data, right? There is going to be a cost involved in that. There is going to be obviously a cost involved in that. So they are saying that you keep the cost constraint also at the back of your mind when you want to choose any of these characteristics of the financial statements here, in such a manner that you don't, say, for example, let us say you don't have transition provisions in accounting standards. Let us say Ind AS 117 does not have a transition provision, or 116 did not have a transition provision, right? How far back in time would you probably have gone to, implement those particular standards? You would have probably had to go from the date of your lease agreement, which would have been, possibly impossible to do. And it would have obviously involved a huge cost here. So what they're trying to say is that strike a balance between the cost which is going to be involved, the amount of effort you can probably take to, to implement that particular measurement basis, or whatever those characteristics are, right? I would probably feel that when I'm saying balance, again, in my opinion, at least the standards have given them, given a lot of, solution to this particular problem. Say, for example, Ind AS 101. It has given us a transition point for Ind AS, right? There's given us a transition provision for Ind AS. The subsequent standards which talk about this, transition standards or transition matrix for those standards or transition provisions of each standard, 115, 116. So they have also provided us enough guidance to ensure that the costs do not exceed the benefit here. So even though the framework does say that this should be at the back of your mind, these individual standards by themselves have sort of resolved the problem.
So, of course, quality prevails over cost.
It does. I mean, again, I think, what you should probably think of is don't vitiate the basic fundamental characteristics of the financial statements. Don't vitiate that, that you should not vitiate the basic characteristics of the financial statements. Keep that in mind. At least I'm not sure, at least in the Indian context, we have not got any complaints of costs exceeding the benefits here, at least in the Indian context. I don't remember any particular,
So very rightly, and I fully agree to that. If you look at some of the exemptions which are given in Ind AS 101 are
Right.
tailored to meet the concept of cost should not be more than what is the benefit which you are going to get. So if you look at applying Ind AS 16 as it is in line with IAS 16 would have required Indian companies to either fair value those assets on the date of transition or go back to the date on which you acquired those assets and measure those assets in accordance with what is the provisions of IAS 16, which is now Ind AS 16, and depreciate it over its useful life. Now, earlier, prior to Schedule 2, we had Schedule 14 to the Companies Act 1956, which gave that straight line method and return on value methods for charging depreciation. AS 11 gave that benefit or option of capitalizing foreign exchange differences to the cost of assets, which are all examples of what is not permitted in IAS 16. And therefore, if Ind AS was not to give this exemption or an option that you apply the carrying cost on the date of transition of PPE as the deemed cost of those PPE, then the cost that the Indian industries would have incurred would have been phenomenal in terms of going back last 30 years, 50 years, or even more than that to arrive at what is the carrying cost of those assets on the date of transition. So that is a very live example where the cost would have been more than the benefits which would have been availed by doing that exercise. And therefore, in view, and if you look at a study paper which the ASB brought out a few years ago about what kind of exemptions were availed by majority of the industries, deemed cost under Ind AS 101 has been very popular amongst most of the brick and mortar companies because they had long history of having those assets over last 30, 40 years, and then finding out the cost would have been a very humongous task for them. So this is a principle accepted globally and forms part of the framework that whatever you do, there has to be a reasonability. The cost which is being incurred should be in relation to the benefits that you expect to get out of that exercise.
That's so. So, what are the elements of financial statements classified as? How are they classified?
Yeah, so elements of financial statements, as we discussed earlier, would, as the framework brings out clearly, is you have income, expenses, assets, liabilities, and equity. And in line with the nature of these elements, they get classified in the financial statements. Now, under Ind AS, we have financial statements where other comprehensive income is part of the profit and loss statement, and other comprehensive income is not present in the accounting standards. And generally, what goes in the other comprehensive income under AS goes in the respective balance sheet items in terms of different types of reserves. Similarly, we have a statement of changes in equity, which is not there in AS. So different elements in the financial statements would get classified basis the nature of those elements.
Right, sir. Mohan sir, you did touch upon this principle of offsetting for assets and liabilities, and I think we have already discussed, and I think we can move on to the next question. Or if you have anything more to share on it.
No, I just have one point to add on this, which is basically that I mean, well, we spoke about what the framework said, but I think what we should and what the participants should very clearly understand is that I gave that example of trade receivable versus trade payable and settlement and net and all those things. If I go back to the accounting standard itself, Ind AS itself, it says that offsetting should not be done unless specifically permitted by a standard. Offsetting should not be done unless it's specifically permitted by a standard. And they also go on to give guidance, which we spoke about a little bit earlier, saying that if you really have the transaction or the transaction risk settlement in it, only then you can offset it. I personally can think of two situations where an offsetting can be done. One is deferred tax presentation. Deferred tax presentation can be given net in the balance sheet because it's specifically mentioned in the accounting standard. Ind AS 12 specifically mentions it. And even if you look at variable consideration in terms of revenue recognition standards, say, for example, discount and incentives or discounts in particular, they can be netted off against sales. Against revenue, they can be netted off. I mean, these are the only two things which come to my mind. Apart from that, if there is, unless the transaction, as I said, is going to be settled in net, you would have to present them separately only and not netted off at the choice of the entity. It can't be done like that. There has to be a transactional requirement to settle in net.
Very well said, sir. Manoj sir, there's also a concept of aggregation. And how is it needed in different parts of the financial statement? And why would we need this concept?
So aggregation is once you different items or elements in the financial statement would be clubbed together in terms of their presentation in the financial statements at an adequate level. So when Mr. Lavi spoke about unit of measurement, as he rightly mentioned, unit of measurement would be there to understand, your set of rights and obligations, and basis that you decide the unit of account. Now, in aggregation, what you decide is what are the items you aggregate at a particular level and when you make a presentation in the financial statements. Going back to your earlier very interesting issue of offsetting, and which was so nicely explained to us by Mr. Lavi. When do you offset is when you have a contractual right to net off those assets and liabilities, and deferred tax assets is a very good example where the assets and liabilities could be offset. Now, very commonly it is seen that if there is one party which is your supplier and you also sell to that party. So the same party is your supplier and is a customer. Now, under the traditional accounting, it was very common to see that the balance is netted and presented in the balance sheet. So if there is, say, 1,000 rupees which I expect to, which I have to receive, and 600 rupees which I have to pay, the two are netted and 400 would be the net amount which is reflected as receivable. But very correctly, what is pointed out earlier is that, do you intend to net it off? Is your intention to settle it on a net basis? If the intention is to settle it on a net basis, then this offsetting is the right is appropriate. But if the intention is to receive 1,000 rupees and pay 600 rupees separately, then your cash flows are different. You expect to have a cash inflow of 1,000 and you expect to have a cash outflow of 600. And when you have different cash inflows and cash outflows, it would not be appropriate to net off the receivable and payable, though it is towards the same party. Because you don't intend to settle it on net basis, you intend to have separate cash inflow and cash outflow. In such a case, offsetting would not be appropriate. Now, this is what actually comes out from the framework very clearly, both under AS and Ind AS. But for some reasons, the practice which had prevailed in the industry and the profession was to show on a net basis, whereas offsetting should be done on a very selective basis, very carefully, and when it is permitted by the standards, as is a very good example of deferred tax assets and deferred tax liabilities.
So if I may deviate here a bit, say in this offsetting, if I offset my trade payable to a trade receivable and as per MS and the other parties registered under MSME. So am I going to into a contravention of the Act of MSME Act also, even if my contract says so that I'm going to net off both the things?
So my understanding is, if you have a contract which permits you to net off, to offset the trade payable against what is receivable from that party, and the due date for that are not in contravention of the provisions of the law, I'm sure you can net off and you will not be found on the wrong side of the MSME Act. But but if you do not have a contract, you are obliged to make the payment to the MSME within a period of 45 days, or within the period of 45 days is the outer limit. The contract cannot be for more than 45 days. If there is no period mentioned in the contract, it is presumed to be 15 days. So unless you have a specific contract, you cannot net off in contravention of the provisions of the law.
Thanks. So as we are at the fag end of our deliberation, I would like to have key takeaways from both of you on the presentation and disclosure objects and principles of the concept of framework for financial reporting.
No, sir, you go first, sir.
Okay. I think we have discussed the framework very extensively. And Nikita, I must admire the kind of questions which you have been putting to both of us. One by one, bringing out very finely the various aspects of the framework. To sum up and to say what are the key takeaways from the presentation point of view, I believe that the accounting standards, I would put it this way, the disclosures required under Schedule 3 and the accounting standards should be taken as the minimum level of disclosures required. And it is good for a company, more particularly a listed company, to listen to the investors, to listen to the analysts, and see what is the information which is being asked for. I mean, both in my capacity as an auditor and also as an independent director sitting on the audit committees, I would always like to understand what is the type of interaction with the investor analysts, what kind of information are they asking for. And that gives many a times a clue that what you are disclosing, what you are presenting is not what the investors are understanding. They want something more or something differently. And the key takeaway from my point to me is that if you hear the investors and you hear the others clearly, you may come across what is being missed out. You may do everything what is required under the law and under the standards, but you may still find that your stakeholders require something more or something different. So one should listen very carefully to what the investors are asking for, and to the extent possible, not in all cases one can give every information which everyone asks for, but if you think it is reasonable, yes, you should provide for that additional information.
Very well said, sir. I mean, I really don't, that is brilliant input from Manoj, sir. I only have one more thing to add to this, Nikita, because I think we understand that we're coming to the end of time, and I will agree with Manoj, sir. I should appreciate you for doing this and asking this most important question in the end, actually, instead of asking this in the beginning, right? Based on my experience, and this is again to all the participants who are listening here, I think please ensure that, see, disclosure for the purpose of disclosure is not going to be of any benefit to anybody right now in the, in the present day and age. So it should be an entity-specific disclosure and not just boilerplate disclosures. In fact, this is specifically mentioned in the framework of Ind AS also. Don't give a disclosure only for the purpose of giving a disclosure. You should have an entity-specific disclosure. I can give an example. You take, for example, revenue recognition standard. Everybody talks about 5 steps of revenue recognition. Everybody says performance obligation. Everybody says variable consideration. We should understand that the performance obligation differs from entity to entity. Now, the user of the financial statements may probably be wanting to know what is the performance obligation, saying just I've got performance obligation, I'm going to perform at a particular period of time. I think maybe, the preparers of the financial statement should look at this sort of entity-specific disclosure without compromising on all the characteristics of the framework which you have spoken till now. Don't just do a boilerplate disclosure. Boilerplate means just taking the words in the accounting standard and putting it as a part of your either accounting policy or as a part of your disclosure. Now, I can give you another example quickly before we close. Say, for example, disclosure of the discounting rate. This is something which, is some companies are giving it, some companies are not giving it. It comes in your actual valuation. I'm talking about other discounting rates, which are used for the purpose of Ind-AS discounting. If you ask me, maybe the people don't understand it very, very clearly, but as a matter of good practice, it is always better to disclose the discounting rate. It's always better. The standard may not tell you to do it. The standard may not tell you. Impairment standard says pre-tax discounting rate, but are you disclosing the discounting rate? So my key takeaway will be, Nikita, that you will have to give entity-specific disclosures. Please understand that whatever we spoke for the last 2 hours, relevant, reliable, faithful representation, ultimately ends up in your disclosures only. It ends up in your disclosures only. What you provide in your disclosures represents all of what you have spoken for the last 2 hours. And I've seen many boilerplate disclosures. My only request to all the participants would be force the entities, force the managements. If your auditors, force the managements to do entity-specific disclosures. That seems to be the key takeaway from all these words we're using in the framework.
So, although we are in this cricket fever and we have both the batsmen still on the field, but I would like my opening batsman to answer my last question. And are previous year's figures disclosure mandatory even for proprietorships and partnerships?
Well, considering the fact that you are giving an audit report, an audit opinion, where you say the financial statements give a true and fair view. And as we discussed, that true and fair view is not defined in the law. True and fair view is compliance with all the accounting standards, all the requirements, both under the framework and the standards and the applicable law. In that context, previous year's figures should be given. Unless the previous year's figures are given there, it will not give a true and fair view of the financial statements. And therefore, I would say it is mandatory from the auditor's point of view when the auditor is giving a true and fair view, even in context of the non-corporate entities.
Thank you so much, sir, for clarifying all our doubts, and a heartfelt gratitude to both the stalwarts. Today, I can understand why you both are epitome of knowledge. It surely was an enlightening session, and I believe it was enlightening for all the viewers listening this session. Thank you so much.
Nikita. You did a great job in moderating this session.
Yeah. Thank you.
It was a pleasure to hear Mr. Lavi. I'm really fond of his presentations and his depth of knowledge. Thank you very much.
Mr. Lavi's examples were a complete package deal.
Thank you, Nick.
Thank you.
Thank you, sir. Thank you all for participating so well and making this webinar more dynamic and enriching through your questions. And I would especially thank my learned speakers and the moderator for moderating so well and taking up the queries of the participants so well with examples. Very well taken session, sir, I should say. And I would, for answering one question, which is this webinar recording available? Yes, sir. This would be available to all the members on the ICI TV, and it is already available on the YouTube channel of the ICI. So stay tuned for more insightful sessions coming up every month. And we are having different other knowledge dissemination initiatives also of the ASB. From the ASB team as a whole, I would like to thank one and all for participating and joining this webinar, this insightful and enriching webinar, sir. Thanks a lot, sir.
Thanks, Charlie. Thank you.
Thank you so much. Thank you.